All right. Checking everything here. We look like we're good to go. We are live. We're back. Dfi-nancial Friday. It's been a couple weeks, right?
It's been a while since I've seen you. At least on the Dfi-nancial show. So
It's been a while since I've seen you in person, Raymond. Again, welcome everyone joining us. My name is Alfred from DiversiFi Capital, and this is our Dfi-nancial Friday show. Now, we were saying it's been a little bit because I think we were off a couple of Fridays ago with Easter, and then we did a separate series with our great lifestyle migration, talking to Daniela and about what it means to be moving to South Carolina. But now we're back. We're back to our normal show. We have been wanting to talk about financial planning, about deductions for work from home. But our marketing person was like, hey guys, a lot of people have been asking about IPOs. We did a webinar last year about what it meant to go public, and there was a lot of hits and a lot of views. And so we wanted to bring this topic back up to light here and talk about it a little bit with Raymond today. Some of the basics, and we actually are going to have a more in-depth kind of webinar that I'm going to be inviting Nathan Dingler, our CEO and partner as well, to be doing a longer version of this talk. But today we're going to talk about IPOs, what it means to go IPO nowadays, what is a SPAC, what is a direct list, but more importantly, right, we focus on personal financial planning, right? So because we talk about personal financial planning, we're going to focus on what it means for the employee, right, or someone who owns equity in these companies when they go public and what they should be concerned about, right? So it's going to be a little bit of an overview, and then again, leading into our more in-depth one that we're probably going to be scheduling first week of May, okay? But again, first, we always start with a market update. We're going to talk a bit about what we're seeing in the last couple of weeks. Raymond's going to run us through that. And then we'll jump into the IPO side, which again, is my favorite topic, but also as a company, this is one of our specialties. We work with a lot of people on this, and happy to share our insight with you guys about it. All right. So again, before we get started, just remember anything that we talk about on Dfi-nancial Friday is not intended to be personal financial advice. It's more of a general education, right? There's a place for that. There's a place for the personal financial advice, and that's DiversiFiCapital.com. You can click on the Get Started page, learn a little bit about what we're about and how we're trying to change the world of financial planning a little bit. And then, of course, if it's something you're interested in, you can see how to do that, okay? When we talk about something like taxes, for example, which we are today talking about some of the implications around equity compensation, right? This is more for, again, general understanding and helping you ask the questions to your tax professionals, right? Or directly to us in your one-on-one sessions if you're a client watching, right? But not meant to be specific tax advice here. And then finally, from a legal perspective, right? We're not attorneys, Raymond and I, right? So we're not providing any legal advice here. And so that should be directed to your attorney contacts. All right, let's get started. Yeah. Markets have kind of, continued along. I mean, I want to say that, a couple of weeks ago, we were talking about, Raymond, that interest rates were headed up, right? We had this inflation worry. And when that was happening, you had a situation where NASDAQ, right, which was, again, you've heard of me saying probably 100 times now, right, by and far the winner in 2020, they were lagging behind something like the value stocks, right, US value stocks with the Dow Jones by quite a bit, right? And so it's catching up. The gap is closing. So what are you seeing right now in some of the data, and what are you seeing in some of the year-to-date numbers? And give us kind of your take on what is going on at the moment.
Yeah. So just a quick refresh of this week's performance. S&P 500 is up 1.37%. Dow Jones is up 1.17%, and NASDAQ was actually up 1.09%. Okay, so overall, I mean, a great week for the markets. And, with the Dow Jones, S&P 500, they're actually hitting all-time highs again. Yeah. NASDAQ is still playing a little bit of catch-up, but from what Alfred mentioned, like when we last spoke about it, that Nasdaq was probably down about 4 or 5% from Dow Jones, like the value stocks, right? But since those past few weeks, year to date, Nasdaq is actually up a little bit above 9% at 9.03. Dow Jones and S&P 500 still doing well at about 11% this year. So Nasdaq has definitely closed that gap by about just 2% now, where value is still leading. Value Dow Jones actually passed the 34,000 mark as well. So kind of what we spoke about before, right? We're starting to see investors switch over from large cap growth over to some value stocks, more cyclical stocks, especially with how we've seen things ramp up with the vaccines. I mean, I've been telling my clients all the time, like, I felt January, February just didn't seem like there was much going on with the vaccines, but I feel like March and April have definitely ramped things up. At least here in California, April 15th has been open to the public now, right? Just yesterday, right? For everyone to have access to at least scheduling a time for it. So we're definitely seeing things picking up. My confidence is picking up. We're hitting all record highs because of economic data and strong earnings that we're also getting, right, from companies from Q1 data. So a lot of good news actually surrounding the market and some potential growth still.
And I think you kind of highlighted it right there, which is we're finally feeling like things are getting better, right? It feels like things look to be picking up, things look to be opening. I mean, this is anecdotally, right? That people are getting more comfortable. I saw Disneyland, right? People are scheduling Disneyland tickets, right? And so, I just feel like there's this idea that you are going to see maybe a new normal, but a little. I mean, okay, here in the Bay Area, we're by Levi Stadium, right? Not quite, but I mean, it's 30 minutes away. Levi Stadium hit records in providing number of vaccines a day. Now, okay, I don't know that I want to be in that line, Raymond, but we're talking about vaccinating over 10,000 people a day. I think they're trying to hit 15,000 over the weekend. It's just, nuts. First off, it's a lot of people, right? But I think in general, that should help people feel more confident, and then it's going to allow for people to be spending more, allow for people to be in outdoor dining and restaurants, right? And so things seem to be trending the right way. But to your point, I think the interesting part was like there was this gap between NASDAQ and Dow Jones. Now it's closed again. Crazy to think that, again, all-time highs, 11+% in S&P and Dow Jones, right? NASDAQ at 9%. You're like, what's going on? Like, the market is just going to keep going or what? And I think that's part of this idea where, guess what, right? A lot of money was printed last year. All that is supposed to go into the market at some point. Now, there's going to be concerns about how they're going to control inflation if all this money starts flooding into the market. But certainly, it's doing its job, right? I mean, I think it's doing its job of continuing to reopen the economy and make people feel good about it. So maybe they got that part right. Maybe they had to print that much money. I think there's going to be an argument about what it means in the long run, right, in terms of all these funds here. But certainly so far, I think it's held us out of a situation where maybe people would be worried about this extended recession. So we haven't seen that. We just haven't seen it. A vast difference from about a year and a month ago, when the market had hit 30% downside, and we're worried about what the heck, when is it going to stop, right? And here we are. Not only did last year recover all of that and had positive years, we have another 10% so far. So I do caution people, and this is not so much like investment advice, this is just experience, okay? In my experience, like, any given year, right? People are always like, well, when's the next crash going to come? And I said, look, in the past 10 years, I feel like there's always been one point or another where the market adjusts 10, 15, 20%, right? Now, the recovery has been fast, but like in terms of how much it's come back. And so I think it's about to happen again this year, right? I mean, I just feel like the way that the market conditions are moving, how people process information wouldn't surprise me one bit, right? If the market took another 10, 15, 20% dive from here, right? I think it's still early in the year. So again, I think that's quite possible. And you just have to keep in mind when that happens, don't panic, right? If you have cash on hand, you buy back into the market for long-term investing. And if you're someone who needs money in the short run, like within the next few months, you probably need to be careful and say, I probably shouldn't be invested in the market, right? And I think, and I think asking the question about when the next crash coming is the wrong question to ask in my mind. And I think the mindset already is not in the right spot for you to be successful in the long term, right? So,
and that's a good point. Just to be cautious. I mean, things had to work perfectly to get to where we are today, right? And it's worked out better than expected. I feel like, just in terms of things being distributed, things reopening again, stimulus going out there, people are spending money, confidence is going up. But I feel like that has to continue for the market to continue to climb this way. And, who knows? Like, we just don't know, right? I mean, there's definitely news of different strains, right, that can impact things. There's the inflation aspect of it. So just, once again, be cautious, have an investment strategy for your portfolio, and make sure we stick to that.
Yeah, absolutely. All right. So I think that helped us cover what we see in the markets in general, right? And so what we're going to do now, right, is jump into talking about, right, equity compensation. And I'm going to tell you, right, like, equity compensation is one of those things where it's driven by, right? Well, you know what, Raymond, what is equity compensation? Let's start there before we get into IPOs and SPACs and direct lists and all these things. But what is equity compensation from an individual perspective, and how does it relate to IPOs and SPACs and direct lists?
Yeah, I mean, when we think about equity compensation, it's a form of compensation that you're receiving as an employee through W-2, but in the form of a stock, right? Your company stock in this case. Now, it could be private, meaning that the company's not public yet. There's no value to those shares. Or it could also be listed on the stock market, right? Whether it's NASDAQ, whether it's S&P 500, or within Dow Jones. And that's when some of the shares do become value in which you're receiving compensation. But then again, it's still considered equity to you, or at least income to you. But once again, just in the form of a stock that our clients are receiving.
Yeah, and we call it equity comp, Raymond, because we want clients to consider looking at that as part of money that they're making. Because how many times do people come to you and be like, you know what, I've received some stock from my company, but I don't count that, right? Like, you hear that all the time, right?
Yeah.
Like, it's just like, oh, it's there. I don't consider that as income. I'm like, wait a minute, right? Like, it is income. I mean, again, from a tax perspective, there's different ways which we'll talk about, but like, it's value. It's value that the company is providing you so that you could stay at the company, you benefit from the company, right? You then, of course, if the company does well, right, you could really, really benefit from the company. But it's absolutely part of compensation. And you should absolutely, as an individual, look at it as, what am I making in total, right, from my company last year? Wages, bonuses, right, and the actual stock piece to it, right? And when you combine that number could be fairly significant, right?
Yeah.
And so now when you own equity and you're in a public company, which we're not going to be talking about as much today because the focus is on IPOs and SPACs and direct lists, right? The public company side, you can receive these things called restricted stock units, right? RSUs, probably one of the more common equity compensations that are being provided. And in the RSU, you're granted some amount of shares when it's just like when you receive your offer letter where it says, hey, you're going to make X amount of money this year. They usually give you some grant letter that says you're going to receive X amount of shares, right? RSUs, 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 RSUs. Can you hear me still?
Yeah, I can hear you, but there's a little bit of echoing there.
All right. How about now?
Yep.
Okay. Sorry. My mic, I think, just went offline for a second. But so yeah, when we talk about RSUs, oftentimes we say, you know what, think of it as income. Think of it as a bonus being paid out to you because it's certainly taxed that way, right? They withhold a certain amount by default, right? Which again, we're going to have something, in my mind, more advanced and more detailed than in May when we talk more in depth about this. But in general, that's one way that someone can receive equity, right? So when we talk about being a private company getting this, I think that's where a lot of the questions come in, because in a private company, restricted stock units are one way that the company provides you equity compensation, but they also do it in form of stock options, right? And so stock options is a completely different animal, right? But between stock options and a couple types of stock options and RSUs, that's probably where I see 100% of how people get granted equity in a company that has not gone public yet, okay? So what does it mean when a company is not public? I think the general sense is, Raymond, right, that they're not traded anywhere. Like you and I cannot go and buy some private company's stock on the New York Stock Exchange, or I can't go into Robinhood, let's say, right, and trade this company because it's not publicly traded. But they're around. They're a real company, right? Like DiversiFi Capital, we are a real company, right? And yet we are not publicly traded anywhere, right? We're a private company, so no one can buy stock of ours, right? And so as a company is growing, you might ask, why does a company actually go public, right? Like, why is it that they go public? Well, when they are in that process of growing a company, they might need money, right? They need capital to be able to grow the company. Public is to raise money, right? So they raise money. They say, you know what? I want to be able to invest in these future projects, right? I want to be able to expand the company, but investors, private investors have already given me enough money. I'm going to take this public so that the general audience, right, anyone can now invest in the company. And that's by going public through an initial public offering. So that's probably the most common, right? We call that an IPO. And guess what? Last year, in 2020, we had a record number of IPOs. Now, if you actually factor in IPOs, special purpose acquisition companies, which is a SPAC, which I'll talk about again in 1 second, and direct lists, like direct listing of just onto a stock exchange, what you have there is almost double the activity. In fact, record-setting activity in 2020. I think it was almost 500 transactions of companies going one of these three routes to go public and thus traded, right? So double 2019. And almost 170 billion of funds or market cap being raised and generated in that process. That's a wild number, right? That is an insane number. And I've talked about in other types of webinars and real estate conferences and all of these, right? About a situation where because of all of this money coming back through, right? Because of all this money coming through, it's driving real estate markets in the Bay Area, right? All of that is being affected, right? But this market, the amount of activity that happened last year is also why equity compensation is one of the top trending financial planning topics out there right now, because the employees, right, the people who own the shares are so confused about what to do with it, because number one, there's a lot of zeros now behind that value, but number two, there's also a ton of tax consequences and investment diversification to be thinking about, right? And so we're gonna try to go over a breakdown of the top tier or top level items right now, right? But again, before I jump into that, there was IPOs, which is again directly listing a company on to a stock exchange, raising funds, right, and then using those funds and trading it on the stock exchange. You have SPACs, which again, actually a SPAC is interesting, right? A SPAC is like you and I, Raymond, would create a company together, and the company has no operations. Okay, there's nothing in it. Like you and I are just going to create something and say, you know what? People trust us to find the right company to buy, and we're going to buy, the target being some private company. But people will invest money in you and I, okay, to say we believe that you can find the right company, and we want to invest in that future company you find. So they invest in the SPAC, and the SPAC goes and buys this private company, and that's how the company goes public. So instead of kind of raising funds directly, they do it in this way where it's called a special purpose acquisition company, right? Where ultimately, it starts out as nothing. It starts out as no core business, and then we go find a company, buy it, relist it onto the stock exchange, and now it's being traded. And then finally, a direct list is a little interesting. You had something like this last year, right? You had a company like Asana, a company like Palantir, right? In the past, a company like Spotify, right? All of these companies did a direct list, meaning they weren't looking to raise money. Maybe they raised a ton of money in the past already, but what they were looking to do was actually just provide their employees more liquidity, right? And allow people to invest in it. What I mean by that is being able to directly put this share without any change in share classes, number of shares. They just put this on the market, allow it to trade freely. And then all of a sudden, those like the employees that have been in there for a while now decide to then, right, liquidate or allow people to buy. And now they've gained cash from it, right? So those are all the different ways that people can take a company, quote unquote, public, okay? So as an employee, like I said before, you have restricted stock units, you have stock options. So in the restricted stock units, Raymond, right? If I am in a situation where I've worked for this company for a couple of years now, I've maybe vested, let's use an example of I was granted 4,000 shares of restricted stock units, and I vested half of them, right? So I have 2,000, but the company isn't public yet. What happens? Like, did they take taxes already? Did they wait, right? Did they wait until IPO? Like, what happened in a general case for a private company?
Yeah, so employees that have RSUs where the company is still private, everything is combined into when the company goes public, right? And this can be a really big issue from a tax perspective, because think about it, right? If you had 4,000 shares, 2,000 vested, usually that would have been broken up between 2 years. I mean, the normal vesting schedule that we see is a 4-year vest, maybe like a 1-year cliff, meaning you don't receive anything the first year. Once 365 days goes past, you receive 1/4 of it, and then so on, maybe through a quarterly basis at that point. But let's say that you had RSUs that vested the full amount, right? The full 4,000 shares. In which case, as Alfred mentioned earlier, for RSUs, it's basically going to be income, like it's added onto your W-2 for that year, right? So this is a common thing that we see, and for where clients need our assistance is making sure that we have enough taxes to cover that type of IPO, especially with RSUs, because there's really not much decisions that you can do at this point. You vested shares, which is great. It has become value to it. But you can imagine that if the share price is quite high when you might have had a really low share price, now it's worth a lot of income that gets added onto, which might even push you into other tax brackets at that point and might even owe additional taxes than you're normally used to. So
I mean, and you're absolutely right, because in a public company, right, the restricted stock units, right, when they vest to you, it will happen kind of incrementally, right? So it still adds up, but it's incrementally that it's adding up over 1 year, over 1 year, over 1 year, over 1 year, that year. But in the example you were saying with me, what happens if I did have 4,000 shares at $100 a share? That's $400,000, right, of income that gets added in 1 year, which you may have never seen on your taxes before. Now, I'm not saying that there's any ways to minimize it, okay? It's more about, when we talk with our clients, understanding and being aware that that is a lot of tax that you're gonna be expected to pay. And even if they, as a company, help you pay for some of these taxes, when I say help for, they're not paying for it, right? All they're doing is, from a logistics perspective, they're gonna sell some shares for you and help you pay for it. What they sell for you, right, by default may not be enough. And last year we did a Money Mythbusters, a different series that we had, and go check that out on our YouTube channel if you have a chance. Right, in that channel we talked about, or in that show we talked about, it's a myth where with RSUs, restricted stock units, that the default withholding that they're doing is enough, right? What I mean by that is the default amount that they're selling and covering for you within those shares is enough. The reality is, for most people, right, if you vested 100 shares and they took 40 shares for taxes, those 40 shares won't end up being enough for taxes, right, for a lot of people. It's just that in a situation where you're private, that problem is multiplied, right? You're seeing that instead of having it incrementally taxed over time, you're going to be generally taxed all at once, right, with those 2,000 or 4,000 shares, whatever we said best, based off of some price when they go public, whether it's an IPO, a SPAC acquisition, or a direct list, the company will tell you, and note, this is a question to ask if you're planning to go public, right? In that situation, what price, what quote unquote reference price are they going to be using to determine your RSU taxation? Is it day one price? Is it average of the first 5-day prices, right? There are actually, right, different ways that can happen. But again, that's going to help determine that price times the amount of shares you had vested going into this event is all going to show up, right, usually on base stuff. Okay, so that is definitely question or problem number one we definitely really run into with clients. Like, wow, what just happened? What tax do I pay? When do I have to pay it? There's all these questions that you're going to have to start to ask, but just letting you know that yes, right, this is all income that comes in. Okay. Is it the same with options, Raymond? Right, like in terms of how if someone had, options that they've vested, but they haven't done anything with it yet, like they haven't purchased it, right? Do the taxes, and maybe it's actually a good time to step back. Like, what is a stock option? We talked about what is an RSU, right? So Raymond, general, that doesn't have to even be the specific category, but what is a stock option?
Yeah, so a stock option is similar in that the employee is receiving shares, or at least the option to purchase the shares. So it's not necessarily theirs in things like RSU, where once you vest it, technically is yours at that point, it just needs to go public. But with stock options, there are two different kinds there, but at the end of the day, it's really the option to purchase the shares. So there is a price to this if clients decide to exercise it for those type of options.
Yeah. So to your point, it's some incentive or some right that they've given you, right? You say, okay, yeah, I've gotten 10 options to buy, the share at $1 or $2 or $3, right? As long as I work there, as long as they're not expiring, I will always have the right, right, or the option to buy this company's share, right, at $1 or $2. We call that the strike price. Okay, the strike price. So in that strike price, what happens if the share is $100, right? Like all of a sudden, that difference between the two becomes taxable, right? But when it becomes taxable is only when you decide to exercise. Okay, now there's so many strategies around when to exercise, should I be exercising early, and all of that. I'm not going to cover that today, right? But what I'm going to talk about is the idea that if you do have these options and the value has already gone up, right? It's some really, really high difference between your strike price and the actual cost or the fair market value of what it's trading at after it goes public. You have to remember that as you exercise, if you decide on day 5, you exercise and sell all of those options, guess what? Just because you've had the option vested for a while, it still is considered ordinary income, because when you exercise it, you own the share and then you sold it immediately, right? And because you did that, all of that difference, we call it, right, a compensation element or a bargain element. That's more of the technical term. Just think of it as the difference between, right, where the stock is trading at versus what you bought it at, right, is all ordinary income if you decide to exercise and sell it right away, okay? But the key point with the options is that you get to decide when you take the taxes. Whereas with the restricted stocks, you don't get to decide, right? Even if you sold the RSUs or not on day 1, if you're allowed to sell it on day 1, that is all still going to be taxed to you, right? And so I think there is a huge difference there. And from a planning perspective, right, how do you change stock options, as an example, to be long-term capital gains, right? Or how do you change restricted stock units to long-term capital gains? And the simple answer is, with the restricted stock units, the initial gain that you have per share when it's vested to you, it's all ordinary income. There's no other way to look at it, okay? Now, if you decided, right, Raymond decided to hold these shares for 1 year and 1 day after he's already paid taxes and recognized it in income, sure, that's fine. Like if the share was $100 in a year, it's $150. Yes, the extra $50 is long-term capital gains, But guess what? The original $100 was already ordinary income. Don't confuse that part of it. Okay. With options, it's different, right? With options, if you haven't exercised it yet, right, but you have the right to, like you have this option, it's vested to you, right? That option in general, you decide, like I said, you exercise it, and all of a sudden you've added that initial gap, right? That initial gap as ordinary income. Now, if you decide to hold on to the share, right, and to try to hold on to it for some time, let's call it over a year, and this will vary depending on the type of stock option, you can potentially change some of that into long-term capital gain if you have the right kind of options, right? And so, Raymond, what are the two different kinds of options that we know of?
Yeah, so the one that you're referring to that does have some more favorable tax benefits would be the incentive stock options, which is known as ISOs. The ones where not as much a tax benefit would be NSOs, which stands for non-qualified stock options.
Yep.
So NSOs, I like to think of it as somewhat similar to RSUs, right? If you decide to exercise it, they're all going to be ordinary income tax brackets to you. But with ISOs, that's kind of where all the strategy comes into play as well, right? If we're trying to aim for long-term capital gains, when should we exercise, right? I mean, if we continue to wait and wait and wait, what happens if the fair market value of the company continues to rise? Right now we're paying additional taxes. So there's always going to be a cost, right, if you were to exercise some of these stock options here. But there are going to be some strategies that we help with our clients in determining how much and when to exercise.
Yeah. So, and what we're talking about, again, ultimately is the option side, a ton of different thoughts that you need to put in if you own these, whether it's before your company has gone public, after your company has gone public, and now, right, and even during, right, your company going public, right, there's different considerations. Just know this, right, if your cost to exercise is lower than whatever the value is, right, of the company once it's gone public, you have to be very careful about whenever you are exercising options, because there's a very high likelihood, right, there is taxes that you need to pay, right? In fact, if your company is private, okay, and your cost to buy, let's call it $1 versus its perceived value, right? Whatever they call the fair market value of the company stock is higher than your dollar. Even if you try to buy and hold it at that time when the company isn't really quote unquote real yet. I think a lot of clients use that. They're like, oh, my money's not even real yet. Like it's a private company. Guess what? There are still some real taxes to pay. Okay. So if you are in a situation where you know you have these stock options and your company is about to go public or has gone public and you're wondering what to do with them, and you're in a situation where the traded value or the perceived fair market value is higher, right, than your strike price, that's where that you should go seek some professional help, right, and understanding when I go exercises, what are my tax consequences? And ultimately, is it worth it to do that? Okay. With RSUs, right? With RSUs, again, it's a little simpler. You may not have a choice. Okay. So even if the value, the fair market value, or the traded price is higher than, right, the price you received it, remember the price you received it was zero, right? It was something this was given to you and granted to you. So all of it will generally be considered income when that first day hits, when that first day is considered given to you, right? And so if you're starting to ask these questions, you're now wondering, man, like I am confused, right? Yeah, guess what? You're with a lot of people. You're not alone in feeling that, right? And it's time to seek some advice for that, okay? And we're going to do our part, right? This is the beginning of talking about maybe this topic again this year, because there's been a lot of focus to want to do that, right? And again, whether it's an IPO, a SPAC, or a direct list, a lot of these mechanisms on the employee side, like relating to the personal finance side, is still the same, okay? These kind of apply across the board. And so as promised, right, we're gonna, if you hit follow, hit subscribe onto our different social media platforms, sometime in May, right, we're gonna do a series, right, with Nathan Dingler and myself, and we're gonna talk about like how to think about the process in more depth than we have today in an hour-long show, where we're talking about things that you should think about before your company goes public, how to plan so that you maximize your company equity and equity compensation, what to think about during your company going public, and what to think about after, right, your company going public. And so that's going to be something coming to you hopefully in less than a month here, and we're going to plan that out. But otherwise, right, hopefully Raymond and I are giving you guys some beginning pieces of thinking through, right, the questions to ask, because the list goes on and on and on. We talk about it day to day. So this is going to be the starting point here. Okay. All right. So again, we will hopefully finally get back to this working from home deductions thing. We've been talking about it for a couple weeks now. Of course, tax time got pushed out to May 17th. So I think, people have, pushed out their taxes, right, and doing it in a little bit of time, in a month or so. So next week in our show, the Financial Friday show, we're going to talk about understanding work from home deductions, what it means for someone who is working from home as a self-employed or 1099 contractor. What does it mean for someone who has a W-2 job? What are the differences? Okay. Awesome. Well, thank you for joining us, everyone. I hope that you guys found the, again, introductory side of what we're talking about helpful. And if it is, subscribe to our channel so that you can be notified when we announce the date of our more in-depth conversation for our IPO talk. But we look forward to seeing you next week here. Again, we're always live Fridays at 3 p.m. And thank you so much for joining us.
Thank you, everyone.
Have a good one. Bye.
See ya.